A very good morning to you all on the Flow Show. Morning to Stel and Kay. How you doing, guys?
Morning, guys.
Good morning, everybody. Is it Friday yet?
Yes.
I wish. I wish.
How are you doing,
Well,
Ryan?
it's always
Right?
5 o'clock somewhere still, so if you want to call it a day.
It's beer o'clock somewhere. Yes, I know.
Yeah, always beer o'clock somewhere. Evening. It's evening where Karen is. So good evening to you, Karen. Yeah, beer o'clock where Karen is, definitely. We're all coming to where you are, Karen. Get the beers out. Yeah, I'm all good, thanks, mate. Let's have a look at what's going on today, lots in the mix. A lot of geopolitical stuff going on as well. Just not so long ago, we had a story out from the China's SCMP press saying that their top military bods have vowed to be on high alert and prepared for war due to mounting tensions with the US. These comments came from a sideline meeting at the current ongoing party Congress, but that's coming from the Chinese mouthpiece, one of the mouthpiece medias there, the SCMP. Moving across to Japan, we're getting very close to the MOF's buttons really being pushed to do with intervention. We've had a load of bods out, as is customary now, every day. Suzuki was out with pretty much the same old lines, but he did change one part. He said that he's increasing the frequency of watching FX markets. It's another subtle warning. Sorry, mate?
What does that mean?
Oh, well, they're going to watch his iPad more than he has been previously.
Yeah, exactly.
It's a small language change, but as far as Japan goes, these small language changes mean something when these guys say it. So, you know, it doesn't sound like a big thing, but they're getting closer and closer and closer to intervention. Dollar yen isn't stopping, although it stopped here at 149.50 this morning. You know, it's been going on now. This leg up through 145 has been going on for days now. They're going to start getting into the speculation mode, and we're going to be pretty close, I think, to seeing some intervention. If we see a big break through 150, you could probably put your hat on the fact that they'll come stepping in. We've also had some of the BOJ members out as well. Kuroda was saying that weakening yen recently has been sharp and one-sided, and intervention was very appropriate. Now, I'm not sure these yen weakening recently comments are speaking about what happened previously into the price intervention. Yeah, that's Kay's confirmed that. So that's more of a...
The yen intervention was very appropriate.
Yeah, the intervention was very appropriate, but the weakening yen comments, he was speaking about the lead up to that intervention. This isn't new, speaking about the moves, I don't believe. You think different, mate?
No, he spoke about the prior intervention when the lines came out, in my opinion.
Yeah.
He was not talking about what is going to happen.
Yeah. Now we've had, if I get his name right, Adachi, saying, also a BOG member, saying that monetary policy does not directly control FX moves, and responding to short-term FX moves with monetary policy would heighten uncertainty over the BOJ's guidance. He's also not convinced that the BOJ, or I assume it's a he, not convinced that the BOJ's inflation target will be achieved in a stable and sustained manner. And prices are rising faster than thought. Again, you know, the BOJ is pumping the line. They don't expect this inflation that they're seeing to last. And it's really putting everything down on the clock. The longer they see this inflation coming in and the more entrenched it becomes, the harder it is they're going to be able to use that excuse. The same as the Fed a year or so ago, saying that this inflation was transitory, wasn't going to last, so on and so forth. They obviously got caught with their pants down over it, behind the curve, anything you like to call it. are the Bank of Japan going to end up in the situation? For now, there's a possibility they are, the way they speak, that they don't see this inflation lasting. He also tipped that we may see an acceleration quite rapidly in inflation in the October numbers. Now, I believe we get those tomorrow. Let's have a look. I think we get those tomorrow. Tomorrow, Thursday. I have to check that out. I thought we were getting CPI numbers. Maybe it's on this.
Friday. On Friday.
Is it Friday? Is it?
Yeah.
Yeah, I knew it was coming Sunday this week. So he's pointing to that we could see an acceleration there in CPI. We've also had the JGB 10 years taking a little step above the Bank of Japan's limit of 0.25%. And the market is throwing around the comments and the thoughts that the BOJ are being tested on their policies, everything going on, the rising yields elsewhere, central bank policies elsewhere, hawkish. Maybe some people are starting to try and push their buttons again on their yield curve control. So that's going to be a bum fight we need to keep an eye on as well. We had that a couple of months ago, if you may recall, where the market was really pushing and caused the BOJ to come out and really get back into the bond market in bigger steps than they were before, just to quash those trades. So we may be setting up for that as well, on top of everything else that's going on. Just on the Japanese stuff, Kay, you got anything you want to add to the noise overnight?
Interesting today is that even Kishida came out saying that the moves in yen were a bit excessive. That just when we hit the first time the 149.40.45, he said they need to take action against excessive FX move, and excess FX vol based on speculation cannot be tolerated. And for a prime minister, that's a quite big involvement. But it has been done before. I mean, Abe was frequently officially not commenting, but always like keeping an eye on stuff as well. So, but for a prime minister, it's a big thing to talk about the currency normally. So I reckon they will have a very close eye on the dollar yen if it goes close to 150 on its own.
Yeah. I mean, we have got yields, sort of US yields are ticking up a bit today as well. So it is giving dollar yen a bit of an excuse to have a little mooch higher. But again, you have to measure it up against what's going on elsewhere. And the dollar is a little bit weaker against the pound, pretty much flat against Aussie dollar. Euro dollar not doing an awful lot, is down a bit. So a bit of wider dollar strength in the market, as I say, and those yields ticking up in the US. So there is an excuse why dollar yen remains bid, but it's that the other times when it's going against what the dollar's doing elsewhere that they'll be worrying about it. Right, so let's move across to not too much out from the Eurozone. Let's start with a bit of data, actually. Let's have a look at the data quickly. So yesterday we got some housing market data coming out. The NHAB housing market index, another big drop there, down to 38.43, dropping from 46 prior. And you can see how steep this data point has fallen. Yet another housing data point that you know, we've been pointing out for a while, has been on the slide, and it's really taking some big steps down, bringing further pain to the housing market, likely due to obviously increased rates. But there are some other factors there as well, shortages of skilled labour, materials, that sort of thing. But that was again significant drop in that index there. Coming across to this morning, and we've had a lot of CPI data. Final numbers from the Eurozone, pretty much confirming the high numbers there. 4.8 unchanged on the core, though the headline did dip back to 9.9% from the flash number 10%. In contrast, UK inflation rose back into 10%. 10.1% it came in at versus 9.9 prior. That in itself was a dip, I think, from 10.1% as well. So a little minor blip there. The core number up as well, 6.5%, beating expectations, higher than last month. We also had the PPI and RPI numbers out as well. Some minor movements there, but all in all, still running at very elevated levels. The input prices there, 20%, a little bit off the 20.9 prior, but still beating expectations. Output, again, a little bit of a dip off, but still higher than expectations. The difference between input prices and output prices can be sort of used as a margin, a profit margin measure for firms. You know, how much it's costing them to buy goods that they manufacture and move on, and then how much they charge for those outgoing goods. So there's still a bit of a margin difference there in terms of input prices increasing faster than output prices, but not a huge difference there. So these costs are being passed on. And this is a sort of number that feeds into the core. The output price feeds into the core inflation numbers. So overall, still very strong there. We've just come through this, or we're still in this political turmoil in the UK. And a lot of the press were going on about how the tax plans and extra borrowing costs were going to raise rates, and how they raised short-term rates and everyone's mortgages were going up. Well, we're largely over that. And here we are, back to the real fundamentals. Inflation still hot. Bank of England still raising rates, may have to rise further than expected based on these inflation numbers. So people's mortgage rates are going to go up anyway, irrespective of the clowning around the government are doing. But that was the data this morning from the Eurozone and the UK. ECB's Nagel was out saying that the ECB should start rolling off bond holdings soon. Reducing the balance sheet, QT, is going to be a discussion for the next ECB meeting coming up. On the gas front, still got a bit of a queue around Spain, where they're not unloading any more gas tankers because storage is full. And von der Leyen was out yesterday saying that gas storage is in the euro area is around 92% full. So they're looking to be well stocked up, and fortunately they're going to get a little bit of a heat wave next week, so that'll keep supplies from being drained too quickly. Over to the US, and Bostic said the Fed can't solve all the problems causing the current levels of inflation. A little bit of a true word there for once from these Fed members, just to say how sometimes powerless they are against inflation. The Bank of England is one of the most powerless against inflation due to its imported nature. Kashkari said, if we can't get help from the supply side, if we can get help from the supply side, we don't need to do as much with interest rates. But the problem he faces is that the supply side isn't helping. We're not seeing the dip in demand. We're not seeing jobs market falling, unemployment rising. We may be on the cusp of it, given the last PMIs and ISMs that we saw, but that needs to feed through. We need to see more than a couple of reports on that front. Also said that the core is not showing any signs of a peak. As we've been pointing out in the US CPI numbers, we've seen the headline dropping 3 months on the trot, but the core has risen 2 on the trot. So there's still a little bit of disparity there. He can also see rates get into the mid 4% next year. And lastly, as far as I've got on me notes, we've got this Biden talking about gasoline prices, doing more to help those. There's a note, or I don't really call it a statement or pre-statement, being issued about what Biden's going to speak about, and it's basically saying that they're going to restock the SPR when WTI prices are around $67 to $72. So if prices get down to there, they'll start buying back oil, refilling the SPR that they've been depleting to keep gasoline prices down. The only problem with that, as we know in markets, is you set a price target on things. People are going to want to hit that price target or keep you away from that price target, depending on what you want to do. And we know that OPEC is promising to cut production. So if they keep price levels afloat, it may force the US to keep using the SPR reserves, but it won't give them their price levels to restock them. So that's the games currently being played there. Any of you guys got anything you want to add?
Just a comment from me. I just want to reiterate the, if you take a few steps back, the underlying situation is still that of sticky inflation. And looking at the UK numbers, for example, PPI input, so input prices are still, you did say they came in below last reading, but they're still, very high and higher than expectations. So as long as these input prices are going higher and higher, then you can't expect output prices to go lower, and you can't expect inflation, which is lagging all this, to be lower. So it's so sticky. And, it pains me to say it as a consumer, I don't see the light at the end of the tunnel yet for inflation. I've said it before, I think inflation is going to start dropping dramatically after the first 2 or 3 months of 2023, simply because of the way it's calculated year on year. And but also because I think the global tightening is going to be taking effect on the economy in a pretty big way. But overall, the main idea for me, the main picture, we're not close to a peak yet. We have to be patient. The other thing I wanted to mention very, very quickly was that we had cash carry from the Fed, Minneapolis Fed president. He used to be, remember guys, he used to be the biggest dove by a mile when he should have been hawkish, and now he's the biggest hawk when you could say that he should start being less hawkish. But anyway, he's now saying that as long as inflation is still accelerating and is still at high levels, there's no way monetary policy tightening should be stopped. And he has got a point there. So I just want to put all those two things together and just reinforce the fact that I think that we're not close to a top yet. No point in trying to be a hero and trying to guess where the top is. I don't think it's here yet, but I think it's closer than it was a few months ago. It is definitely a lot closer, but at the moment, I wouldn't try and step ahead of this. So that as a result, I wouldn't want to step in front of this. Sorry. As a result, I really, really wouldn't want to be a long risk unless it's for a very, very short-term trade. Anyway, just my 2 cents.
Yeah, thanks, mate. Always worth your 2 cents, definitely. Okay.
Data news front, nothing to add, mate. This afternoon, Canadian CPI should make the loonie move a bit. It's been a bit a yo-yo of late, so it's going to be interesting. Things are still moving, barring the euro and the yen, which is very steady but weakening. Yeah, I think the rest could still be a little volatile, although the market seems to quiet down a little bit. Right, we did see a 100 points range from top to bottom in cable this morning, but it does look that after data move is done, things seem to start to want to quiet down just a little bit, but that's likely only going to be temporary until next week's central banks and stuff.
Yeah, we've got 3 of the main central banks next week: Eurozone, BOJ, and BOC among them. Due the PBOC potentially tomorrow, so see what comes from there. Some expectations that they're going to leave rates unchanged, but they are one they like to surprise markets when they feel like it. So yeah, and just a quick look. We'll take a quick look at some of the odds or the rate probabilities. Let me get that up for you, guys and girls. So just have a look at what the probabilities are pricing among the central banks. So the top one there, the Fed, you can see that we're pricing 75s or 100s. For the ECB, it's 75s, 50s. Bank of Japan, nothing and nothing. Bank of England, again, pricing 100 BPs or 75 BPs. SMB, which is way in December, so don't need to worry about that. Bank of Canada, a 50 pip hike is expected next week, 80.3% probability according to the pricing there. RBA is on a 25.50 pricing, RBNZ 75.100 pricing. So you can see that for the majority of central banks there, we're pricing still up at the high end of potential increments, with only really the RBA looking at more normal hikes, let's call them that. So that's where we stand as far as central bank meeting goes and the expectations there. Unless we get some real big shifts in the data, I don't think we're going to see much change coming into those. And as we get closer to the orbit of the ECB and the Bank of Japan and Bank of Canada, then we can probably expect currencies of those to settle down a little bit. So again, for me, just trading right now, looking at the prices, it's a bit of wait and see. I'm waiting on levels. I'm looking at levels. Where am I going here? Let's get into my proper charts there. So as you know, something like dollar yen, I'm continuing my short build, trying to space out the entries up to this 150, just to keep my risk a bit low. We are finding a bit of a ceiling here at 149.50. Those who are in the chat room will know a good reason why that's happening. And the same can be said for things like cable and euro dollar. You know, we're having a bit of a move, but we're not really going anywhere at the moment. You know, pretty much a week of a fairly tight range we've seen here. So for me, this is one of those times where I'm just managing what I've got, waiting for the levels to come to me rather than trying to chase the levels around the board. Aussie dollar's another. I've been building longs in, as I've been saying here. Again, these minor levels are still holding, you know, 63, 40s, 50s. I want to see that taken out. I want the price to get above 64 to at least start turning around the prior week's trend. But in the meantime, we're you know, bouncing off the middling levels. So it's not a lot for me going on at the moment. I'm not dipping my toe in too much while we're having this sort of little pause for the moment. Kay, do you want to do your little circuit?
Yes, sure, mate. I'm not going to have to look at too much more than you are right now. We're taking requests, folks. We're taking requests. Yeah. We're feeling a little bit like DJs today. Yeah. What record do you want? Still, we might need to get some of your charts out, mate. Some of your longer term stuff.
Really? You want to see that?
The 30 years. Yeah, the Greek stuff, nothing below the 30 years. Yeah. No, just what Ryan was saying. We had this quick spike in the Japanese yields. Well, I mean, we're still like hovering around this 26. Okay, this is not the not completely updated. This one, I don't know why, but anyway, we have those spikes above 0.25%, which is the yield curve control limit of the Bank of Japan right now. I think it has to do with what I'd actually said earlier, saying that there are expectations for inflation to rise above 2% in the October readings, which are due on Friday. Quick look at the 10s. It seems like this like little channel is a bit too tight. I should perhaps widen it out a bit, but if you look at it now, we're holding above like 3.94% right now. No, that's the UK. Why am I on the UK? This is the wrong one. Okay, this is better. The US 10s, we are back towards the highs. As already mentioned by Stelios in other shows, there is a real possibility, I think, if inflation remains sticky and the data in the US do not materially deteriorate, that we could have an extra push higher. And I think the signal will be a rise above this 4-10%. The 4%, as I've shown before, on the really long end, it's a bit of a fib level as well, but in the really long-term stuff. So as long as we are hanging here and above, there is a risk of pushing higher. I think the short end as well, the 2s and the 3s, they are just around this 4.5%. They could easily push through if the market believes that the US data are not deteriorating too much right here and now. What's happening in the next months or after the turn of the year perhaps is a different story altogether. But into the end of the year, also taking into account QT liquidity issues that may pop up, because we have seen, thanks to one of our people in the ForexAnalytix room, that M2 flows are starting to be negative. They have been like a real yo-yo. So I'm not sure whether they are any good parameter for the medium term, but anyway, in the short term, and perhaps into the end of the year, we may see a bit more of dollar shortage. I really would not exclude it right now. So on the yen then, well, Ryan has his view. To me, if I take out all the rest of the FIB, so now we're hanging around this 1.618 extension of the intervention. I did show this triangle. If you put the target up there, it's around 150.30. It's also a possible target of this wedge going up. It's all happening in my playbook around 150, 30-40, call it. And that would, if the psychological barrier of 150 gets taken out and we get a stop run, that would be a reasonable target, in my opinion, at least in the short term. Kuroda is still easing. He still hasn't changed his wording. They're changing their wording on the yen and on the moves in the yen, but he isn't changing monetary policy. And I've also seen that the Japanese government is trying to put in place another 30 trillion yen stimulus package. So you have Japan, the actions of the monetary policy and government stimulus are still very much working against the Japanese yen. And then you have the dollar yields going higher. And then you have all the other central banks where Sterling, the Bank of England, ECB, you name it, all the other central banks, barring PBOC, they're all raising rates. So the yen does not, in my opinion, does not only have a dollar problem, but has a problem versus all the rest. And we can see it on the yen pairs and the yen crosses. They're all pushing higher. And I think it's a big ask to stop this move. Call it speculative. They can do it like last time, put it 4 or 5 big figures lower, which is good for people who are trying to pick tops. But for the time being, to me, the fundamentals and what's happening on monetary policy are not in favor of the Japanese yen. If you look at it from the yen point of view, I think if we start to see a reversal in the current account, reversal in the trade dynamics, then the yen would have a natural incentive or a natural possibility of strengthening a bit. But for the time being, for as long as that doesn't happen, I still think it's very, very tough to counter trade all this, although we are getting at lofty levels. On the rest, then really it's we're hanging around this 98.25, 98. We try to get up closer to the trend lines around 99. The figure is the first one now. That was the parity one that we had a couple of weeks ago. That's now coming down, and that's been replaced by the longer term one taking the other tops, and that is now like around. It's actually below parity, but anyway, again, if ever euro would push higher, I think parity is going to be again the big battle where it's won or lost. For the time being, it's just in a range, really. If we start to break below I think below here 97, 60, 70, then there's a chance of going back to the low 97s, and why not 96.5 somewhere. But for the time being, there's very, very little to really do in there, unless you're trading the really short-term day-to-day stuff. Cable, as I showed yesterday and the days before as well, same thing really, since the failure at 115. Then we had the failure around this trend line on the Monday fixing, and now we're gradually moving back down. I think 112. We're holding around 112.5 for now, and then you take 112, 15, 25 as well on the cable. Should be a bit of a support area there. There's a lot of support now coming in down to 110. I think every 40, 50 points you're going to find support. Lows as well, prior lows as well. So if it ever goes down, I think it's going to be a slower process. For the time being, I'm very much in a range sentiment on the cable. We have had some weaker candles. Yeah, I don't know, Karen. Really, I don't know about these dollar yen weaker candles. Is it a bit of nervosity, bit of the dead hour between Asia and Europe walking in? It's all possible. I don't think they have been checking rates. Otherwise, those weeks would have been probably longer than what we have seen today. I'm not really paying too much attention to them, to be perfectly honest with you. I think an interesting one is euro sterling. I've been talking about it yesterday as well in our room, and then there's a bit of traffic here, right? 87.25, 87.45, call it 87.5. It's an interesting zone. It could top out here for a little bit and have a retest. Why not somewhere into the mid 86s or so? I must say that on the shorter term, since we are going to have ECB and BOE, I'd be inclined to say that we are going to hold setbacks for now, just because of the size of the European bloc and the difficulties that BOE is facing compared to fiscal policy in the UK. There are those expectations, 75 to 100 BPs. I'm going to stick my neck out and say they can't do more than 75. 100 would be a bit rich, in my personal opinion, right now. So I'm going to go for 75, which would be sort of what ECB is going to do. But I think also with what Ryan was mentioning earlier, that storages in gas, etc., are looking pretty okay for this winter, at least for the first months. A bit of mix between fundamentals and pictures here. I'm inclined to say we are going to find support somewhere, and I think this one was a bit of a fakie. All right, so much for that. Dollar CNH. Back to or nearly back to what we saw at the end of September, 726. We're talking about this dollar CNH, and it's funny that PBOC is trying to hold it back, but then we have this uncertainty in the markets about the why they are delaying the publication of the GDP and other numbers. Officials are saying it's just because the CCP Congress is going on. Others are saying that it might mean that they need a bit of time to, how shall I say, force the numbers, or at least that the numbers will be really bad, which is possible because they are still in COVID lockdowns. They are still the numbers are at a 4-month high over there, so it really may be that GDP, if they publish the real data, are going to be absolutely bad. But then this level is interesting because, okay, even if they don't really want to holds CNH in a range. CNH is like the offshore market, which is the like between brackets the free market. That can go wherever it wants. But we've noticed that every time we are like around 2.25% above the CNY fixing, is that it looks to be a bit enough, you know, and we are just there. We just went up above 725, and I'm not going to chase it here, and I'd say be a bit careful chasing longs if by trading it up here. So there's a possibility for me to see at least a little bit of a setback, or at least a bit of a range. Lastly, or a couple more. That was an interesting one in the past few weeks already, months already. This channel is pretty firm on the dollar end. Yesterday early morning Asian time, we had a retest of the bottom end of the channel, and we're seeing a rebound again. We are not flying too high, but this is a 1% move, so it's not nothing. So I'd say keep an eye on this channel in dollar rand. I think it's quite interesting, and could be a harbinger if for any dollar weakness also, or any positivity in risk if this starts to break. So keep an eye on that one. For the rest, no change. We went up to some levels here, prior tops and bottoms in the euro mix yesterday. I still think nothing has changed. I'm a bit cautious with the stuff right here and now, especially into ECB perhaps next week. But if we start to break back below those levels, my view still hasn't changed. It's a carry trade position, and I'm in it for the long term still, and for as long as we are at least below 20, or even here in around the 2040s. And I'm going to stop it here, Ryan. There's a bit of cross trading going on in the different currencies. I think there's probably more cross trading going on than anything else right now. But I think for today that's good enough.
Yeah, cool. Thank you very much, mate. And what I'm going to do is actually pass it over to Stelios in a moment. He's going to come and show some of his charts as well. Now, Stelios and the other guys, Steve and Blake, obviously do some of the webinars later in the day. And for those who may not know, there are some specific ForexAnalytix customer webinars that are run purely, as I say, for people in our chat rooms. Only available there. This show is obviously free. F.A.C.E is free as well later on. But there are other webinars that take place during the day for anyone who's on the platform. So if you want to come along, I'll put the link to the platform in the chat there. Prices have gone up last week, but you can still grab the exclusive Forex Flow discount there, 20% off by using that code FFL20, and you'll get full access to all those other webinars during the day. And with that, Stel, I shall hand it over to you, mate.
Thank you. So I will give you an idea of the kind of stuff we talk about, or I talk about on the Morning Edge, which is a members-only webinar. And for those of you who don't know, I'm not a day trader. I tend to look at a much bigger picture, and my trades tend to be a lot more lengthy, let's say. But the way I see things at the moment, I always start with yields. Yields for me have been driving everything for the past 15 years or so, ever since the 2008 crisis. And we were talking about equities for years and years about how overvalued everything was pre-COVID. And the answer always was, well, what's different? Why should markets fall when risk is basically free? Right? It's you can borrow for nothing. Even corporates did that. Like Apple was sitting on, I don't know how many hundreds of billions of cash, and they were still issuing 10-year bonds because they can. At low rates, and they use that to do buybacks. And we had, a decade of buyback led and low rates led rally in stocks. So now we are seeing yields obviously make a big turn. And if you look at a bigger picture chart, the 10-year US, it was basically on a downtrend from the 80s. And we had this bottom after COVID, and we haven't looked back since. And we are now at a huge level. This 4% ish level is trying to break. And unfortunately for risk, I think we probably have one final push higher in yield. So I think we're probably going to get to 450 or so in 10-year US, maybe a little bit above that. And that's going to be terminal, in my opinion, because that's going to coincide with equities going another 10-15% lower from here, and B, inflation slowly coming down, as we said before, probably in the beginning of 2023, and all that combined with severe demand destruction brought by tightening. That's going to bring economies a lot lower. Growth is going to go down, unemployment is going to go up, inflation going to go down. You remember, unemployment and inflation is a lagging indicator, so it takes a while for unemployment to start rising, and I think that's going to happen. So for now, I'm looking at yields, and I think these are going to break, and if they do break out higher, then you definitely do not want to be long risk. Not yet. There will come a time when you want to be all in long risk. Maybe not all in. All in anything is not good, but in my opinion. But I think we will probably get a move towards these pre-COVID highs, 3,300-ish. And I think that's the place where the Fed is going to really change their tune. And as I said before, I think this is probably going to come in the first few months of 2023. And that's basically when the Fed's going to tell us that tightening is over, or it's going to be close to over. And this is what the market's really waiting for, because at the end of the day, real assets, and I include stocks in this, right? You have companies like Apple, they have infrastructure, they have products, they have everything. Real assets, as the monetary supply expands, their prices is going to expand. I'm not saying it's going to happen one for one straight away, of course not. But when you have US debt going from 1 trillion to 20 trillion within 15 years, anything dollar denominated, supply and demand being equal, being unchanged, it's going to go up. That's maths 101 and economics 101. So everybody's looking to buy a dip in stocks, because we all know that you close your eyes, you open them in 10 years, they're going to be higher. But the question is, where's your entry? Where's the best entry you can get? Because if you go even, if you look at stocks on a 10, 20, 30 year basis, we're going up, we're following. If you look at the total US debt chart, it's very similar to this, obviously without these peaks and troughs, and not going to be coinciding exactly, but this is what's been happening. So that's going higher. The question is, how do you time your entry? I think at the moment it's not the time to be long risk. I think we're still in sell the rally mode in risk, and I've been talking about 3,900 in the S&P being a good first level. There's a lot of nice little points of interest here, and we have the 50 DMA also hovering around there. We could get there. So, if, as I've said in F.A.C.E. and on the Morning Edge many times, don't be a hero. Don't try to go against the trend unless you're trading on a, hour by hour basis or minute by minute basis. It's very difficult to time it. But anyway, this is what my big picture idea about yields and risk remains this, and it extends to other assets, because let's face it, we're all trading pretty much the same thing. Yields are driving everything, stocks, the dollar, metals, everything. You're seeing gold, which theoretically should be doing very well in times of inflation, but short term, it's not, because tightening, the Fed is tightening, so risk is being sold, so everything's getting sold. Theoretically, the gold should be doing a lot better, but it's not. So I wouldn't, my medium-term view in gold is quite bullish, actually very bullish, gold and silver, especially silver, because there's a lot of application on it. It's used in solar panels, all this new technology, cars, EVs, everything. But in the short term, you have to respect the price action. And, again, if you look at the monthly chart in gold, look what's happened to the price as monetary supply expands? Well, it's going up. Obviously, there's peaks and troughs, and this is why I'm always talking about trying to time it right. So for now, gold is looking weak, and I think these lows are probably going to get tested. And as I said before, as yields break higher, which I think they will, risk gets sold, and everything gets sold with it. So gold probably going to break this 16, 17 low and head towards, I don't know, what's the next level, 1550, something like that. But I do think that this next move is going to be terminal. So if you're an investor and you're looking at a very long-term trade, these are really good levels to get long gold, and especially silver. Silver is also teetering on the brink here. 1760, whatever this low was. I think it's probably going to get tested and broken. But patience is required. That's what I keep saying. And for people who know me and who followed me for years, I don't trade that often compared to other people, but silver, for example, my last trade, I got in the in 2018, mid 2018 at around, what was it, 15 and a half, something like that. I can't remember exactly. I have to go back and see. And I kept the position for over a year and a half. I was down considerably in during COVID, but I tend to trade these things with very, very little leverage, if any. So I kept it there, and then I got out at an average of about 25, which was, if you annualize that over 2 years, that's not a bad result. But you have to be patient. You have to believe in your trade and know why you're in a trade. So I'm not saying people should trade like I do, because it's a very peculiar way, but I'm just describing what I do, what I usually do. So I'm waiting to get very, very long gold and silver, especially silver. But way price action is going now, I'm not pulling the trigger. So patience yet again. Anyway, that's just a broad view on the way I look at things. As I said before, I'm not a day trader. I'm a very, very more long-term trader. But the big is then I think yields are breaking out, or are going to break out, and I think we have one final push higher in yields and lower in risk. So be very, very careful if you want to go against that. That's what I want to do. I know I speak very quickly and have a squeaky voice, but hopefully, it's not boring and people understand what I'm trying to say.
Yeah, thank you very much, mate. Very informative as always. Always good to get a different perspective on how people trade. We want that from this show. Don't want it just to be about me, Kay, and everyone else. We want to hear from the viewers as well about how people trade. Paul's asked quickly, any thoughts of oil? Let me share my screen quickly. I think with oil, we're going to face a situation again where we're going to be watching the data for signs of recessions. The global growth story hasn't left us. It was something that we were trading before. That's a lot of the move down over the summer. On global recessions and that sort of thing, that hasn't left the picture, but we're not talking about that at the moment. Different things are going on elsewhere. I think that's going to reassert itself. I can't see any reason to be massively long oil except to play off the levels. Obviously 76 has stepped up as a big level. And we've got resistance coming in the 92s, 93s. So range-wise, that's what you really got to be looking at. If you're looking at WTI, if Biden confirms this plan that he's got about the SPR, that they're going to come in and buy it 67 to 72 bucks, potentially gives you a bit of a backstop if we do see dips. So if you're going to get a dip down to those sort of areas, then maybe you got to look at an SPR trade, let's call it that. On the back of that, Paul, you're looking longs, looking to buy here. Okay. Well, you've got your charts, you've got your levels. I'm sure. For me, I'll keep it fairly on the wide, as I say. Maybe looking at 76, playing the SPR trade, and obviously any move we see down at those levels that are tied to the SPR, people are going to be front running it, and they're going to be offloading it probably up towards the 80s, something like that, if they're buying down at the 70s, 72s. So yeah, keep an eye on that if you're looking at oil, factor in those sort of things that are coming into play. And with that, I think we shall call that a day. And Kay, you got any last minute thoughts you want to add?
No, not really. I do agree with Stel though that we are going, as I said before, we're going to have a last push on those yields, and I'm having a sneaky feeling that we may have a bit of a pain trade in the dollar coming up. Everybody's looking for the pivot, and I think the pivot might come after everybody got stopped out on all the dollar shorts that they are running right now. That's just my my personal little opinion here.
Yeah, and you know, for something like dollar yen, trading it at the moment is very difficult. You know, I know a lot of people want to catch an intervention trade. They love to catch the Bank of Japan coming in, but you know, where do you want to be holding shorts? Did you want to try that at 147, 148, 149, even 150? You know, how many times do you want to try catching intervention? You can't trade it unless you're trading a very wide price range. You can't trade it an intervention. So you can't buy it here for the risk of intervention. You can't sell it here because of the uptrend that it's still in. So, you know, sometimes you just have to pick your spots, but be very careful and very tight with your trades. Lastly, before we shut up shop, please don't forget the Traders Summit coming up this weekend. I'm really getting excited about that. A couple of folks I'm interviewing, Trader One SZ, big in cryptos, if you know him from TweetSide, and Western Nakamura and Michael Brown. We're going to be talking central banks, dollar yen, and everything associated with those. That's on Friday. But a big program coming up. The link's in there if you want to check out just what we've got on, and if you wish to register, please do so there. And with that, I shall wish you a good day ahead. Trade safe, make loads of pips. Thanks to Kay and Stel, and we shall see you bright and breezy tomorrow.
Thank you, Ryan. Thanks, Cayman, and thanks everybody for being here.
Thanks everybody.
Cheers, guys.
Bye-bye.